Hi, and welcome to Your Finance TV. We're here with Jeffrey Hughes, founder at Alpha Insights. We're doing our weekly synopsis of Jeff's Alpha Insights, which is available on Substack at hugeinsights.substack.com. And of course, don't forget to like and subscribe to Your Finance TV to stay on our content. We're comfortably through 3,000 subscribers and adding more every day and week. So thank you very much for your support. Jeff, welcome back.
Great to be here, Mehdi.
So I guess since we last spoke, the S&P's up about 2.5%, quite cheekily, sort of grinding away. But let's have a little deep dive into your piece this week. So let's kick off as usual with the top down.
Yeah, as you put it, the S&P was up actually about 2.4% last week. We posted a new recovery high on Friday and then another new recovery high yesterday. Sentiment is now, kind of ranking in that realm where it did right around the all-time record highs in the market, going back to November of 2021 when the NASDAQ and the Russell peaked. We continue to see the broader market lagging, and that's a concern. And then thirdly, I would say that, momentum has begun to diverge negatively. We just are not seeing the momentum of the broad market, keeping up with price. And we like to see that confirmation. It's not there. And, the final issue that has us concerned is our preferred Elliott wave count continues to point to a top in this counter trend advance, as we've been describing it for some time, as wave two, primary wave two. And we think primary wave two, which is the bear market rally, in our opinion, looks like it has either topped as of yesterday or is absolutely very close to topping. And in fact, the cycle topped yesterday. We've talked in the past about the cycle composite, and that is, an aggregation of three cycles that Ned Davis runs together. And that cycle was expected to top on the 17th of July, and it should trend sideways to down over the next 4 months into late November, if I'm not mistaken. And so, given that criteria, we are expecting the market to start to, reflect some of the economic deterioration that, has been kind of missing, right? Everybody's been kind of been waiting for this recession. It hasn't materialized. And the reason for that, in our opinion, is because, there's very long and variable lag time that exists between monetary policy changes and its actual impact on the economy. And we expect to start seeing the effects of that monetary policy tightening in the third quarter, and we think the stock market will reflect that as well.
Well, Jeff, one of the things that gets punted around by people of my age, I guess, there's a lot of young people in this market who haven't necessarily seen a lot of cycles over the last couple of decades of investing like we have, right? So I feel like you're kicking off this week's piece with a bit of a history lesson. So run us through this.
Yeah, I got in the business back in 1990, Mehdi, so only 33 years. I'm still, not even an old timer yet, but I've seen enough that it concerns me when the market starts to look like it did in 2008. And where we see the strongest parallel is when we look at the share price of Citigroup. And this week we put together a 30-year history lesson on the story of Citigroup, and I think there's a lot of lessons that can be learned from this story. Back in the 1990s, a few people will remember that Citigroup was the best performing stock. It outperformed Cisco, it outperformed Dell, it outperformed Microsoft. It was the best performing stock in the S&P 500 throughout the decade of the 90s. And in fact, the stock topped not in March of 2000, but in August of 2000, August 31st to be precise, at then $58.31. When I think about people looking at the price of the stock today and it's, mid 40, high 40s, they don't realize that there was a 1-for-10 reverse split. And so if we think about, what was the price of the stock on a split basis, it was $580 at its peak. That stock declined to 7 cents before they implemented the 1-for-10 reverse split. And I think it had closed the day somewhere around maybe 97 cents when it hit those lows back in March of 2009. And, institutions could not buy a $1 stock. And so, the management of Citigroup had no choice but to do a 1-for-10 split to get the stock price back up to $10. But you had, 1/10 the number of shares at that price. And so we look at kind of the wave count that existed back then in kind of parallel to what's going on in the market today. And, people think, well, hey, we're in this new bull market. We've broken out above the 200-day moving average. We're, coming out of kind of a visible base formation. And when we look at Citigroup, you could have said the exact same thing about it. In fact, we did a wave count assessment of Citigroup back in the day and redid it, this weekend. And we said, well, look, we had 5 waves up, no question about that, and 5 waves down off of the all-time high. And that was what we would describe as corrective wave A of an ABC pattern. Wave B actually retraced 89% of that wave A decline, more than doubling. The stock price was up about 112% off of its lows. People think that, oh, if we're up 100%, we're at new highs. No, we're not. Carvana was up 600% last week. That's one way to look at it. The other way to look at it is to say that Carvana is now only down 87% instead of 95%. It's not a new bull market just because the stock price goes up by a large percentage amount. Those percentages are very high off of low levels. Citigroup declined 54% during the tech wreck off that 2000 high and retraced 89% of that decline. And for reasons that at the time were inexplicable because people were bullish. Investors thought that Citigroup's prospects were incredibly bright going forward. And then suddenly, without warning, the stock plunged below its 200-day moving average and collapsed 99.8%, lost essentially all of its value, and has been dead money ever since. For those who believe that it can't happen, this is a lesson that you should not forget.
So you see this being applicable to the broader market as we speak now at these kinds of levels?
I do. I was having a conversation with a friend of mine who is an ex-floor trader and an expert technician in his own right. And, he proposed a theory to me, and I haven't bought into this theory, but, I'm all ears and open-minded to, anyone with his level of experience and knowledge. His view was this: it's that it's possible that the market could trade all the way back up to its all-time high and maybe make a slight new high and suck everyone back into the market right before the bottom falls out. And, his thesis really revolves around, the debt is the catalyst. And I concur. We've written extensively about the risks posed to the broader financial markets by excessive leverage in the system, both at the corporate level and at the government level globally. And so this certainly is not lost on me, but it really got me thinking. And when I kind of paralleled what's going on in the markets today with the lessons from Citigroup, it made me think about the Dow Jones Industrial Average. Because if you look at the pattern in the Dow, it looks very similar to the pattern in Citigroup back in 2007, 2008. And so, when I think about where the Dow is today, my suspicion is that, it's the lagging senior market, right? It is the senior index, and it has not even taken out its December 13th recovery high yet. That was 7-8 months ago, right? So it has not made a new recovery high for 8 months. Well, what if this lagging senior index were to make a slight new recovery high? Wouldn't that have the exact same effect on investor psyche as the S&P making a new all-time high? What they would think is that, well, look, the S&P and the NASDAQ have been leading, and the Dow and some of these other indexes have been lagging. But now the Dow has confirmed these breakouts. It must be real. But in our opinion, we're just tracing out a corrective waveform, WXY. And that WXY needs one slight new higher high in order to be complete. And that's likely to coincide with a peak in the overall markets and precede a major decline in the market. So, I think the setup is very, very similar in the Dow as it was today, that is, as it was in Citigroup back in 2008. And I would not be at all surprised to see things play out in a similar manner.
So, Jeff, let's flip to something you mentioned in your opening statement. So, obviously, the market has been ticking up higher, but you mentioned momentum seems to be running out of steam. Can you talk us through this?
Absolutely. So, there is a considerable negative momentum divergence that's evident in the S&P 500 momentum study. We do a 10-day momentum study, and this momentum study really looks at price relative to its 10-day exponential moving average. And usually what you want to see is that when price is making new highs, it's extending further above that moving average than its prior highs. That suggests that we're seeing an acceleration in momentum. But what in fact is happening is that price is not. It's actually converging with its moving average, which suggests that there's a deterioration in the momentum of the market. And so, oftentimes you see this as a signal to a trend change. Well, the last time that we had this signal was on February 2nd, where price made a new high and momentum made a much lower high, and subsequently was followed by a 10% decline in the S&P into its March banking crisis lows. Well, here again, we're making a new high. And in fact, as I mentioned earlier, the cycle peaked yesterday. We made that high yesterday, yet momentum is diverging significantly like it did back in February. And it is typical that we would see this precede a major reversal in the price trend. And so we are proposing, and we are also suggesting that this is supportive of the other data that we've been discussing for some time. The sentiment data that we've talked about, the breadth data that we've talked about extensively in recent weeks, and in fact, our Elliott wave count, which appears to have peaked. So all of this suggests that we should see a major trend reversal in S&P 500 prices.
So let's have a look at the short-term Elliott wave. Obviously, every week, week in, week out, there's things changing. So are you seeing any changes in your levels?
Levels, not so much. 4 weeks ago, we went out with an upside price target of S&P 4534. That was the 78.6% retracement of the primary wave one decline into the October lows. And so we've now effectively achieved that. We didn't hit it precisely, but came very, very close. We also exceeded a level that we pointed out a few weeks back of 4509. Which is the level or the point where wave Y in our account is equivalent to wave W. That is a common wave relationship, an equal swings move. And so that equal swings move into a 78.6% retracement of Fibonacci level suggests to us that that is important resistance, and we should expect that to reject price. And so far, we haven't gotten through it. We would be concerned if we did get through it on a sustained basis. For example, a move of more than 1% above that level would probably cause us to reconsider where we are in the wave count and make some changes to where we are. But at this point, we have the highest confidence in our count that we've had since October, mainly because we have a lot more information, right, to work with. But at this point, we believe corrective wave, primary wave 2, has topped or is topping at this very minute as we speak, and will be rolling over into primary wave 3 down in the not too distant future. We believe that wave 3 decline will carry prices to new bear market lows, significantly lower than where we're at today.
And that ties into the supercycle thesis as well, which I assume hasn't changed at all based on anything over the last couple of weeks.
There's no real change to it. In fact, one of the things that we've been looking at, and as you know, we've posted this chart repeatedly week after week, looking at the cap-weighted S&P versus the equal weight S&P. And what's interesting to us is that the equal weight S&P gave us a clue as to what the cap weight S&P was going to do. It retraced 78.6% of its decline, but it reached that in February. The February 2nd high was a 78.6% retracement off the October lows. Since that time, we've seen 5 waves down and 3 waves up. that looks to us like primary wave 3 down has begun in the equal weight index, and that the cap weight index is lagging. It's being held up by 7 stocks that we've dubbed the Magnificent Seven. And, we think without the support of those 7 stocks, we know for a fact that the S&P 500 would be negative for the year. And so, that tells us that there's just not a lot of strength in the market, broadly speaking. And with this weakness in momentum, the setup to us looks like we're heading south in a big way. And we think that could carry the S&P 500 down to a range of around, say, 26 and a quarter to 26.25 on the S&P 500, down to perhaps as low as 23.50. I'm favoring the high end of the range, which kind of comes in around, say, the 161.8% retracement, or I should say extension, rather.
And are there any marked changes in the internals?
Well, not a lot of changes. If we take a look at what has got our attention this week, it's the collapse of breadth. If we take a look at last week, we saw a collapse in momentum, and momentum actually rallied into a lower high. Again, with the prior momentum study that we just mentioned, we're seeing this negative divergence on the 5-week RSI oscillator as well. So there's multiple measures of momentum that are showing this negative divergence. Breadth saw an utter collapse last week, and now we're looking at the 5-week moving average of net advancing issues as being decidedly negative at this point. And so that again is something that investors should be concerned about. And then finally, I point to net advancing volume, which was only about 35% of total volume last week. And honestly, we're more interested in the 5-week moving average of the up-down volume ratio, which is now well below 2. And that is not a bullish signal. Let me be honest about that. You want to see that 5-week ratio somewhere in the north of 5x, closer to 7, 8, 9 times. That would suggest a raging bull market. South of 2 times is a weak market. Okay. Because you got to remember, 70% of the time the stock market goes up, 70% of the days the stock market goes up. So we should be looking at something well above 2 times on a up-down volume ratio basis.
And Jeff, how about investors? They seem to be getting a bit more optimistic.
I would say so. We've looked at countless studies of investor sentiment. We're publishing this chart looking at the NAME exposure index. This is professional investors' exposure to equities, and it's up to 93%. That's the highest it's been since November of 2021. And I would call that pretty fully invested for this, professional cohort. It can get up to leveraged, north of 100% invested. We're not there, but I wouldn't expect us to become leveraged at a counter trend advance, recovery high. So this is very bullish sentiment from professionals. And if we look at individual investors basically are much, much more bullish than they were, say, back in October, where the bull bear spread for the AAII survey was negative 42. Today, we're positive 15. And that's down a little bit from positive 22 last week, but still very bullish. We've looked at other sentiment measures like the VIX being down around 12, 13% in recent weeks. We've also looked at different surveys. For example, the Investors Intelligence Survey of Advisors got up to 75% bulls recently. The DSI Daily Sentiment Index for futures traders was 93% recently. I think the CBOE equity put call ratio, we look at the 10-day moving average, that got down to 0.39, the lowest level that we've seen in 2 years. And so that suggests that option buyers are exceptionally bullish at this point. And all of these measures together just, kind of inform us of the environment. There is a deep level of complacency evident among investors across various asset classes. There seems to be speculation running rampant in the market at this point.
So, Jeff, looking at everything, you also have been looking across different market cap indices. What are these telling you? Because obviously the breadth has been under massive question here.
Yeah, and again, it kind of supports my last statement. Speculation trumps safety in the market right now. We can see it by, the NASDAQ 100 equal weight index, which was the best performer last week, up about 4%. A lot of small cap indexes, including the Wilshire 4500. These are the 4,500 stocks below the S&P 500. They were the second best performing average. Small caps, micro caps, mid caps all outperform the S&P 500 and the Dow. And so when we think about safety, we think about large cap, Dow Jones Industrial blue chip stocks, right? Those were the worst performers last week. So no doubt there has been more of a speculative sort of foray in the cards. And what's interesting to us is that the Russell 2000 had a big up early part of the week. If you look at the spread between the Russell and say the NASDAQ 100, it was up 5% initially and then ended up negative for the week. And so, we think that, basically there is a shift into kind of this speculative, idea that the market's broadening out. But at the same time, people aren't all in.
So, Jeff, what about on a sector basis? Is anything jumping out at you?
Yeah, again, offense trumps defense. That was kind of the message of the market last week. We saw discretionary comm services, technology, all leaders. They were up somewhere between, say, 2.7 and 4%. And I think you look at, for example, actually, I take it back, about 2.8 and 3.3%. That was the range for those. You take a look at staples, healthcare, and utilities, and those were up about 1 to 2%. So, definitely with every sector up last week, you saw the focus was on offense versus defense.
So, Jeff, we'd be remiss without mentioning them. You did mention them earlier, but what are your thoughts on the Magnificent Seven about these levels?
Yeah, well, the takeaway there is that NVIDIA trumps everything. The stock was up 7% last week. Apple was unchanged. And so, if we think about, the S&P being up around 2.4%, NVIDIA clobbered it. It was followed by Meta up 6% and Google up 5%. And so, more of the AI play and less focused on the hardware play, the iPhone cycle, But to me, it really kind of just shows that this is a bit of a blow off here. And, the top that we think, probably was put in yesterday was the end. And NVIDIA's, weekly performance last week, is kind of the bookend to that, if you will.
So, Jeff, everyone knows this, but we still have your weekly picks, your top tradable, actionable ideas, 5 longs, 5 shorts. But obviously, Jeff, people have to subscribe to get the real info. So I'm urging everyone, go check out Jeff's content on Substack at hugeinsights.substack.com. Jeff, as always, love you sharing your thoughts from Alpha Insights.
Always a pleasure.
And everyone, again, don't forget to check out his content on Substack. Until next time, thank you for watching and good luck investing.